On this week's dose, we welcome Larry Aschebrook, founder and managing partner at G Squared, a venture capital firm specializing in growth stage tech investing with a unique focus on the secondary market. Larry and his team have backed some of the biggest names in tech. Think Uber, Spotify, Airbnb, Instacart, Pinterest, and many, many more.
Yeah, what a list of companies there, and there are a lot more where that came from. In our conversation, Larry takes us through his journey from college athletics early in his career to the private markets eventually, breaking down how he built G Squared and why he saw a massive opportunity in secondaries, a crucial liquidity bridge between early stage startups and the public markets.
From there, you can expect a masterclass in venture strategy, as Larry shares stories from investing in some of the most prolific companies of the past decade, along with a few that got away and the lessons learned along the way.
Yeah, we also couldn't pass up the chance to get his take on Stripe's decision, which was detailed in the All In podcast a few weeks back, to stay private as a mega unicorn, and Robinhood's bold move recently to open up private investing to everyday investors.
It was truly a pleasure hosting Larry on this week's Dose of Venture Pill. This was an awesome episode, and Larry's amazing. Without further ado, let's dive into our conversation with Larry.
You see here, kid, you gotta just go for it. Don't think about what comes after or what came before. You just gotta bend your knees, take a deep breath, and jump.
This is Venture Pill, your weekly dose of startups and venture capital. We break down recent startups in the news and interview founders and investors to help you stay informed in the evolving world of venture. On this week's dose, we welcome on Larry Aschebrook, founder and managing partner at G Squared, a global VC focused on growth stage technology companies primarily through secondary opportunities. The firm has invested in many big names that our pilgrims know and love, like Uber, Spotify, Dropbox, Pinterest, and many more. Larry, welcome to the show. How's it going?
Thanks, Brandon. Thanks, Sam. Great to be here. Thanks for having me.
Sure thing. Great to have you here. Kicking us off, would love to start with you giving us a feel for your career prior to G Squared. We know you ran businesses and raised millions at ASU. How did you ultimately decide that VC was your next move and with G Squared?
Yeah, it's hard to believe. It's been about 15 years since I started the business. At my kitchen table, probably not that far from where Sam's sitting in Chicago.
Nice.
When I was in college athletics, Brandon, like you, pursuing your MBA, I chose later in life to go back and get a formal business education. When I was in college athletics, my primary job was a fundraiser for athletics. And so I got to meet a lot of really interesting, successful people working at 5 different large state institutions. And they all had one thing in common. The people that had enough money to give some to their alma mater typically made it in private businesses. And, I wanted to do something different with my life. My whole childhood and early adult years, people valued me for my ability to run and throw and my athletic attributes. And very few people, trusted in me, the ability to do something from an intellectual perspective. And I chose to go back to business school to find that opportunity and to give me confidence, really. And Arizona State, great place in Tempe. When I was there, it was fun. We did a lot of great things, and I was fortunate enough to be around some really influential people over my time, and got me interested in really the venture capital ecosystem. And so I decided to put out my own shingle and start a business, and took me a few years to raise $35 million, only for people that were tired of me asking. So they gave it to me. I don't think they expected a return. What does this jock know about deploying capital? Is kind of probably what they thought. And I just started hustling. Companies wouldn't return my call because the fund sizes were so small. And our cell phones started to really, in 2000, from 2009 to 2011, really change our lives. And we started operating our lives off of our personal devices. And I just started calling random people that worked at companies and asked if I could buy their interests. And that's really how it started. Small pool of capital, me hustling, buying Twitter and Spotify and Uber and Lyft shares and Pinterest, and just getting people to return my calls and offering them some value for their stock. And thankfully today we're pretty sophisticated manage over $5 billion, and about to raise our seventh vintage, and it's been quite the journey.
Yeah.
I wouldn't recommend it for the listeners out there. It's a little harder than I make it sound.
Yeah. Well, it sounds like a crazy amount of hustle, but it almost sounds like you stumbled into this like trend. Like companies are now staying private longer. When did you realize that? Like, tell us more about that thesis and how it developed into something that maybe was bigger than you would have thought. I don't know. Like, give us.
Yeah, it was really in at the Carey School of Business at ASU, trying to find things that I was interested in and listening to the people around me that had generated, generational wealth, and trying to figure out, like, why is there so much value in private companies, and how can I unlock the value for myself? And it really, and I'm excited for Brandon as he explores his business school there in New York. And hopefully finds some inspiration there. It really that's where it was, because the research was showing that there were fewer broker dealers, fewer companies starting to go public, larger funds being raised out of the financial crisis. And I'm a pretty simple person. It kind of 2 and 2 there equaled 4 to me. It just was like, well, companies are going to stay private longer because there's more capital and there's fewer ways to go public, and there's probably a chance to participate in this. And turns out it was the beginning of this massive value creation. It's the right time, right place with some luck. And, 15 years later, you managed $5 billion and have had some success. So, and then the people around us, of course. I mean, it's not just me anymore, and we've got a sophisticated business, but it's really, I think, right place, right time a little bit, and then the courage to jump in without knowing what the hell you're doing is a little bit of it too, and starting something fresh.
Yeah, you make it sound so simple in hindsight, but definitely want to acknowledge how much hustle.
Well, when you're in your early 30s and you've went through a divorce, and half of nothing's nothing, Brandon, you don't have a lot to run. So there's not a big risk happening at that point. You're just like, what else can go wrong?
Fair enough. Moving on, as we mentioned at the top, you've backed the likes of Uber, Spotify, Dropbox, many others. What's one consistent trait you look for in a winning company, or even the team behind the company?
Yeah, from the beginning, I've always wanted to deploy capital in and around the disruptive assets, and doing it with conviction and kind of a smaller portfolio with a lot of risk in a few names. And what I've been drawn to from the beginning is still the same today, which is I want to back in any way I can, the fastest growing, most dynamic technology companies, and that they're revolutionizing the existing industry. So if you look at over time, the logos you mentioned, they changed the industries they operated in, and those founders, visionaries, to see that there's a better mousetrap and then have the courage to go attack it. Really is the DNA of these people, and it doesn't always work. There's been plenty of misses in the G Squared history, but all of the founders in our big positions have the same thing: is this unrelentless ability to survive and to achieve, and not being afraid of the fight. Because it doesn't matter if it's the companies that helped us gain our momentum early, the ones you mentioned, to the ones in our portfolio today, of the Anthropics and the Wiz and the Michael Rubins of the world and the Fanatics, is they see this opportunity in some cases that doesn't even exist, like an Anthropic. Like, it didn't really even exist when he started the business. To have the vision that this is where it's going and then the ability to create around that is pretty remarkable, and you feel it from founders. And I think one of the challenges as a secondary direct buyer that the market faces is you often don't get to feel that passion. And that's why most funds in the secondary market either do the LP stake purchasing, where you're buying a portfolio, or you're doing an indexing kind of strategy where you're buying a bunch of secondaries. Our strategy has been, let's provide something different to companies in a service, and that will unlock the access. And thankfully it stuck. And I think really it was Spotify that started that for us.
Yeah, maybe tell us a little bit more about the story with Spotify then. Curious to know a little bit of that background.
Yeah, well, the Spotify story has been pretty well documented. Doc and Campbell wrote a book, Going Public, and there's a few chapters in there specifically about it. So I'll save you the reread and plug him so you can buy his book and help him continue to be a bestseller. But the formula there has been repeated, and it doesn't matter if it's Coursera. You're working in an ed tech company now, Sam. Coursera we were the largest shareholder of Coursera. The same recipe, which is you go in, you help companies stay private longer, you do tenders, you buy shares from others that need liquidity, and you build a very large position over time, and your cost basis just looks very differently. And so that's our Spotify was really the company where we perfected it, where also they recognized the issue early of what would it mean to stay private longer, and to, instead of going public at $1 billion value, why not go public at 8? And those turns on increase in value to the balance of the shareholders or new shareholders, you really need to transition that cap table. And today it's amazing, the scale. In the beginning, nobody wanted to return our call. Today we get inbounds from companies you'd be surprised to know the names of, where they all have the same issue. Any fund manager that's been around for 10 years has a vintage where they can't get liquidity, and they're dying for liquidity. And it's the same kind of recipe. Spotify was really the big first one that trusted us, and then that kind of, to the logos Brandon mentioned early, helped us get to the next, and to the next, and to the next, and to the next, and now it's kind of ours to mess up, so to speak.
Yeah, the strategy is really fascinating. We wanted to ask also about this rifle to cannonball philosophy. Found that interesting. Maybe you could expand on that. Testing small, then going big. What's that about?
Yeah, so it's probably more of my personality coming out in portfolio management, which is, if you're going to do anything, do it all the way and do it big, or why do it at all? And but to try to do it with less risk. And so the thesis is in the beginning, it was the little capital that I had and a little bit of friends and family funds that I put together. I didn't want to lose their money. So being naive enough, my idea was put a little bit of money in, see how the company goes, and then back a few out of the many you started in. Now today we call it land and expand and fire the rifle to calibrate the cannonball, and all the marketing things our terrific IR team have come up with. But really at the end of the day, the process is the same. Is you want to get the data, you want to study, you want to really know what you have, and then you want to, in my opinion, you want to put 80-90% of your risk in 10 companies. Liquidity is a fund manager is very hard by itself. I can't imagine funds that have 100 positions and how they get ultimate liquidity. It's hard enough getting liquidity with $1 billion or $2 billion per vintage in 10 names. Like, I don't know how you would manage it otherwise. And so the decision is push the risk to a few, know them well, dollar cost average in like you would the public markets. And like I think Roger Federer said it best, I think he won 54% of his single points in his career. 54% of the points he won. And he's the best tennis player of all time. And so you just have to be right a little bit more than you're wrong. And when you do it in big numbers, the law of large numbers take over, and then, you're able to raise a lot of money. So.
Yeah, no, it's a beautiful thing, and we'll give you the verbal trademark on rifle to cannonball. Curious to hear if
Lee
you.
Cole, Lee Fixel might not like that from Tiger. I might have borrowed that from Lee back in the day. We'll give him credit for that.
Okay. Curious though, using that analogy, have there been any rifle shots where you've missed and decided not to go with the cannonball?
Sure, plenty. Mostly it's because of I would take a current one in our portfolio, CoreWeave, great business. I mean, fantastic, going to go public at some crazy number. Just raised in value so fast that's where the strategy's got a flaw. Because now, for everyone that's like a CoreWeave, I can share with you one that wasn't, or 10, but it does happen. And the inertia to be like everyone else, I think one of the benefits of being in Chicago and our home base, even though we have an office in San Francisco and we've got one in Zurich and Miami, and you don't get drawn to what everybody else is doing, how everybody else looks at it. Like if we were a Silicon Valley based firm and had a different mentality, we probably would have put 200 million in CoreWeave. Now we would have made a lot of money, but for every CoreWeave, there's Fast, there's a Bolt Financial, there's you name it that went poof. There's many, and so I think that it enables us to deploy a lot of capital with fewer misses than others by staying true to it. Now you miss out often, and also your cannonballs don't always work. 23andMe is a great example, very large position for us. Disaster of a company from a return perspective. That hurt. That was painful. But thankfully, 7 others in that fund make up for that loss. But it's a big loss. It's not small. And the strategy kind of gives you that. And that's going back to the Roger Federer. If you have 8 companies, you're equally weighted to make up your risk. If 6 of them work, you're in a good place. If only 2 of them work, be looking for a job. So
yeah. Interesting you say that being in Chicago, and of course I'm biased. I love this city, and I think it's got a future with the tech scene. But it's interesting the perspective that actually not being all caught up in the Silicon Valley, hype cycle almost. It gives you a little bit more clarity from an outside perspective. But it clashes with other advice that we've heard, which is, you want to be where all the innovation.
Yeah, we have an office there. You're 100% right, Sam.
Yeah.
I mean, you need to be in the flow, and you need to be, AI came out of San Francisco, the Bay Area, right? I mean, it's a couple large positions for us in our current vintage, and the ecosystem's there and it's thriving. I'm just saying from a deployment personality perspective and focusing on secondaries the way we do versus, and believing we can add value by being a secondary investor versus convincing ourselves that we're better operators than Woody Marshall at TCV. Like I'm not a better operator than Woody. I'm not going to be. I don't have the experience, the history. The 2 of you are growing up in the industry. I didn't grow up in it. Like I don't have the skill set in many ways that people in my role at large firms have. Ours is more of let's be a service provider in a different way and show that we can add value and unlock the data, because that's the biggest challenge in the secondary world is getting access to the companies to underwrite like a primary investor.
And so segueing from there, I can't really think of a better person to ask. Just want to hear your take on an idea of where you think the secondaries market is headed in the next, let's say, 5 years, and how you see G Squared being positioned to lead the way.
Yeah, well, leading the way, I think is one that's tough to qualify. I think for us, continuing to be relevant is important. And what do I mean by relevance is making sure that when Wiz needs a tender done, or if it's Anthropic running a big secondary through a bankruptcy of FTX, that we get a phone call because our brand means something and that people see the willingness of us to build positions through hundreds of transactions. And that's to fight the inertia to just go like everybody else and have a minimum check size is difficult. As you scale, we've done 500 transactions in the last few years in a subset of our portfolio companies. So that's buying every share, Brandon, that you come to us and say, hey, I'm, Wiz, and I need to help this employee buy the shares. I've got an early stage, investor that needs liquidity, buy the shares. And you're just doing it constantly. That's a lot of transactions. And oftentimes it's very small scale. So I think to lead the way, we got to continue to evolve our offering to companies to be relevant. And I think the secondary market is really, people finally are waking up. I can't tell you how many companies we approached from 2011 through 2020 who said, hey, that's great what you do. I don't really need your help. Thanks, but I'll take 25 million for the primary, or I won't even talk to you. Today it's they're all needing it. And with only 4,000 or so public companies and over 4,000 private businesses that likely could be public, you have this fundamental shift taking place. And it's not really interesting for public market investors to buy a business that's 20 billion in market cap, 10 billion. Well, how many companies are a billion to 10? And they're just ignored. We call them zombie corns. Awesome businesses, raised money in 2021, profitable, growing. We've told them all to get profitable and cut people, so they have, and cut costs. Now they've overlaid AI or implemented AI in their businesses, and they look fantastic, but they raised money in 2021. They're 5 years away from being worth what they were in 2021, and they all need help. So I don't think it goes away. I think the continuation fund vehicles have really kicked off, helping managers with liquidity. And I don't think there's broad liquidity in the market, even if you get public. There's just not enough liquidity to help the demand. And so I think selfishly, of course, as a secondary investor, the next several vintages were fine. What it looks like past 2030, I don't think anybody knows,
Yeah. Love that term, the zombie corn.
Yeah. Well, I don't know if I want credit for that one. I don't think it'll be as popular as Eileen Lee's unicorn. I don't want all these companies. You just imagine the cover of TechCrunch with a zombie corn.
That's pretty funny. Yeah. Well, wait, we won't broadly share it. We'll keep it between us.
Well, we'll say Brandon came up with it. We'll give you guys credit for it.
I'll take the grenade on this one. Yeah.
Well, you also have companies that aren't zombie corns. They're massive, multi-decacorns. And we wanted to ask you about Stripe, one of the largest private companies of all time. The Collison brothers went on All In podcast. I thought that was an awesome episode. For those that didn't check that one out, it was pretty cool. They're really looking to stay private for much longer. They don't see a need to go public. Do you think that, with folks like that leading the way with such a large company, tens of billions of dollars worth of value, do you think more founders will follow along? Like, what's your take on that?
Well, first to them, congratulations. What a fantastic business, and it's one of, early on that got away from us. And I know now they've really embraced the secondary strategy, which has enabled them to stay private this long. And you'll continue to see that in the better assets. And I don't think that changes anytime soon. And I think, the companies that can hopefully one day achieve, we're talking about 92 billion was the tender or something like that, or 70. One recently was 70. I think they're doing one at 92 billion. Why would you go public? I'm $92 billion behind SpaceX and OpenAI. Is it the third most valuable private company in the world? It might be, right?
Yeah. It's crazy.
It's crazy, but fantastic business, right? So if you look at Adyen and how it's like comped, or how it'd be comped if it's a public company, you can see why they'd want to stay private, right? Like the public companies today, I think it's a fundamental problem in the public markets where you have these businesses in the private side who have invested in growth and technology and R&D in Stripe's case, I don't know, how old is it?
Like 15 plus
15
years.
years old, and every year they can invest in new technologies and new in an R&D budget that's healthy. And when they want liquidity for their employees, they just go ask their 5 largest shareholders, and they raise their hand and say, "Yeah, I'd love to buy more stock because you're a fantastic business and you're continuing to grow at an outsized pace for your scale." If they were public, how do they continue to grow like that? With
Yeah.
public market investors saying, let's drive it to, you want more profitability, more EBITDA, let's no R&D budget, and every 30 days we're going to judge you. That doesn't. I mean, why would you want to be a public company unless you really needed it?
Hmm.
And with the ecosystem evolving on the secondary side, you're seeing continuation fund of continuation funds. It's like, where's the end? If I'm an LP today, just frankly, if I'm an LP, and I am in many funds, thankfully you get invited to participate, and you see this stuff going on, and you're like, it's just starting. It's really just starting, in my opinion. We're like, in a baseball term, we're like, you're not even through the third inning as
Yeah.
far as where this goes. And I don't see a robust IPO window anytime soon. Going back to, yeah, Stripe would be super, super, super interesting for public market investors. We'll see how they like Klarna, and that's one that I missed. The Spotify founder introduced me to the founder in Stockholm. It was like literally the street behind Spotify, and stupidly, I didn't invest. Might not be sitting here with the two of you guys if I did. So,
Well, it's exciting. And, the other company kind of recently in the news we wanted to ask you about is Robinhood, and how they're kind of really expanding their offering into other types of markets rather than just stocks. Obviously, a big play into crypto.
yeah.
Vlad mentioned recently that they want to get into private company investing and to expand that to the masses outside of people with the access. What's your take on that trend and the ability for individuals to get access to these opportunities like you are?
I think it's awesome. I think it's about time, and what a pioneer in the way he's thinking about it, right? I mean, first of all, the business is, it's amazing, right?
Yeah.
So it's hats off to what they've built there, and the investors that helped them get there. It's another one that we looked at that somehow passed on. Dumb that we are, but. Yeah, I think the democratization of the secondary market is happening before our eyes, and I think this is an interesting way to allow the rank and file, to get access to an ever closed market. I still really hope one day there's some type of exchange, probably with some type of blockchain technology that helps settle the ownership. Fundamentally, at the end of it, though, the companies and the Series A investors have to change the thought process in the way that they deploy capital and take capital, because it all goes back to those shareholders agreements and being able to actually own the shares that you're buying. And I think it's awesome that the secondary market is so robust today. It's pretty easy to get price discovery on an interesting company. There's a lot of platforms out there. And I think this is just another example of people really wanting to get access to the world's best assets. And in most cases, they're private companies today.
Yeah, that's well said. 100% resonates with Sam and I, and some of the other companies we've covered in podcast history are breaking down those walls to other secondary markets or unique asset classes. Taking a step back, Larry, this has been awesome. Would love to hear what advice you may have for our pilgrims, which is what we call the listeners of Venture Pill, who may want to gain exposure to innovation either through investing or on the operating side, or just break into the private markets and startup space.
Yeah, I think as far as investing goes, what an amazing time for people who want to take part in the value creation in private companies. I think the impacts of AI. Of course, you have the LLMs and the compute power and the data centers, all those things that are amazing and frankly a little bit above my pay grade as far as comprehension in some of it, but the way AI is being implemented across portfolios and taking great businesses and making it even better. And you see it with earnings like Salesforce earnings, and you see it with AI cloud in the cloud, and just across consumer internet businesses, and how they've been able to really improve as a private company their P&L and their margins. And then to be an investor who wants to take part in that, and how do you go do that? There's more and more venues becoming available. That's the exciting part. To me, the scary part is there's a lot of entrants in the market that are aggregating small investors who have some cash to deploy, and they see that I'm not, or they're not getting access to this asset class. And people need to be really careful with those SPV aggregators. Coming out of the last big wave, if you look back at when this all started, and you look back at the Facebook SPVs and the LinkedIn SPVs and some of the Spotify and Twitter SPVs, at the beginning of this craze, years ago, a decade ago, there was a lot of fraud and a lot of bad people that were taking advantage of people's interests. And I don't think it's all that different today. And so people who are looking to get exposure and investment into this, do your homework, really understand what you're buying. Don't just play the headlines. And then as far as getting involved what an amazing time to get involved with the startup community. I mean, every business today that's created, doesn't matter if it's in Silicon Valley or in Boston or in Paris or in India or Asia, AI is embedded in the business from day one. How amazing of a journey for people from today forward. We've had this enormous value creation the past 15 years. All of us are interested in private companies. And now I think it's going to accelerate. And that's what's really exciting. And people can now participate in it, in the democratization of private assets and the different platforms that are legit to do it. And then, getting a business education to go and make it even better for people, I think is going to be important again. And because our industries went through a period where it wasn't. And now it is, I think. That being able to utilize those tools at your fingertips in a different way than my generation. You guys are a generation behind me. But there was kind of a middle generation between the two of us that didn't really value the business school education, didn't really see that they had to be different. They all went on the same path. And I think your generation has an opportunity to really take the best of the learnings from the past and amplify it and really have an exciting future where you'll see an acceleration of Moore's Law, so to speak.
Yeah. Well, that's awesome. Yeah, you've got us fired up, and I know that the listeners will feel the same way. Larry, we really appreciate you spending all this time with us. And we want to make sure that our listeners can find you, follow along with your journey with what G Squared's working on.
Sure.
What's the best way to stay in touch?
Well, I'm not much of the social media distributor of information. However, our IR team and our comms team does a fantastic job with our LinkedIn page and some other mediums that you can find us. If you want to find me, I'm pretty easy to find. Larry at gsquared.com. That's pretty simple. And happy to talk to anybody who wants to chat, and really appreciate you guys having us on and allowing us to tell a little bit of our journey with you. And I'm excited to hear the podcast, and I'm a big fan. I listen to all of yours, and it's humbling for me. Every time we get an opportunity like this, I started the business at my kitchen table to today. It's humbling to think that there's interest in our business and what we're doing. And I'm thankful for the opportunity to chat with you.
Well, yeah, pleasure's all ours. It was awesome to have you on, Larry, and hopefully we can do it again sometime.
Sounds good. Thanks, Sam. Thanks, Brandon. Take care.
Thank you.
Yeah.
Thanks, everybody.
Thanks for listening. Join us next week for another dose of startups and venture capital. And as always, we appreciate our pilgrims spreading the word about the show. Share with your friends and help someone else make the pilgrimage. See you next time.
told me that she only bumps my music when she's lonely. Thinks my vibe's a little low-key, okie dokie, that's alright, but wait, I don't know how to do things different.